Well, we've heard from Richard several of the ways in which tax competition, tax havens help other countries. And he's talked about the symbiotic relationship between Jersey and the UK, and the same in the Far East between some of the low tax jurisdictions out there and the major economies. And I'm sure we'll hear more from Geoff about how Jersey and the UK enjoy this beneficial relationship between each other. And one thing I saw in the Foot report the other day, this is the government's own investigation into offshore jurisdictions. Apparently, Jersey banks raise more money on the international markets for UK banks than the Bank of England's entire quantitative easing programme. Huge volumes of money coming into the UK there, and I'm sure Geoff will talk more about these things later. Richard kindly mentioned my book that I wrote on tax competition, and in there I looked at many different ways in which tax havens help larger economies. And there was a quote from there that people keep raising, largely because whether they're against or sometimes even in favour of tax competition, they find this hard to grasp. What I said was tax competition brings great benefits to all society, not just those who actually take advantage of it. And that's what I want to talk about this evening briefly, is that the biggest benefit from tax competition, and therefore from tax havens, goes not to the businesses and investors who use it, but to millions of low-income people in high-tax countries like the UK, even if they haven't even heard of a tax haven and have no idea what the international tax system is, they're still benefiting indirectly, hugely, from the availability of these offshore low-tax jurisdictions. I'm just going to mention two ways in which this works. One, well, what does tax competition do? One country decides to lower their tax rates to attract international business, investment, whatever. Other countries then have to respond, otherwise they're at risk of losing too much investment. So one of the main results of tax competition is that high-tax countries like the UK, the EU, are unable to raise their taxes to the ridiculous levels that we saw in the 1970s. In the 70s, because of exchange controls and so on, tax competition did not work very well. So we ended up with 98% tax rates and the economy virtually ground to a halt. Tax competition stops that happening. Okay, it doesn't mean the race to the bottom, which European governments are always afraid of. We've not got zero taxes in the UK. In fact, tax rates haven't dropped that much over the last 10 years. But it's put a brake on governments' desire to raise taxes. Rather than just bringing in more income and spending more, they've had to try and use the money they've got more efficiently because it's preventing them from raising taxes too high. And what does that do? Well, we know the problems of taxes getting too high. You get less investment, you get less work, you get fewer business startups. In other words, you get less growth, less economic activity, fewer jobs. Okay. There's an example I always give to my students that I hate gardening. For me, gardens are something to sit in having a drink. But what I'd rather do is sit there and write an article on tax, get paid for that, and pay someone else to mow the lawn. And I can get £75 for writing a little article about tax, and my gardener wants £20 for mowing the lawn. Everybody's happy. My editor's happy, my gardener's happy, I'm happy. Unfortunately, due to the tax system, my £75 can end up only being £38 after tax. My poor gardener, who wants £20 in his pocket, well, I can have to give him £44 so that he ends up with 20 after tax. So in other words, I get 38 for doing the work, he wants 44 for doing his. The thing suddenly becomes economic and stops happening. Result, everyone's unhappy. I have to mow the lawn, my editor doesn't get an article, and the poor gardener hasn't got an income. That's just one very small example, but it's happening all across the economy. Everything that you do that's going to create economic activity, create wealth, involves a pain and a gain. You've got the pain of going out to work, or of studying harder to get qualifications to get a higher salary, or the risk of setting up a business, or having to save money, put off spending in order to invest and get more in the future. All of those involve pain in the hope of a gain. High taxation leaves you with the pain, but takes half the gain away. And suddenly these things stop happening. So that's one way in which tax havens actually help high tax countries, because they've given external discipline to prevent them from ending up with the stupid high tax rates that we saw 30 years ago. The other way, which Richard briefly mentioned, is providing efficient capital markets. And I used to work in international taxation. And I'm not going to, as an advisor, I'm not going to go through precisely how you use tax havens, but basically, if you've got international investment, you've got an investor in one country, a fund, collective investment fund in a second country, investing in companies whose headquarters is in a third country and whose subsidiaries are in 18 other countries. Each of those countries is trying to grab a bit of tax as this money flows through. And the more countries it flows through, the more bits of tax they grab. Now, when the OECD was doing something useful, they tried to stop all this double and triple taxation through tax treaties. Unfortunately, they failed, and we've still got lots of it. So there is a big disincentive to international investment that you end up with double, triple taxation. One way of solving that is to put your investment fund in a low tax jurisdiction, so at least there's one part of the jigsaw where there isn't another slug of tax being taken. So low tax jurisdictions enable that efficient pooling of international capital. They allow it to be gathered from all over the world and placed in the countries where it's going to do most good, most of which are the industrialized countries, the UK, Germany, USA, because that's where the things are to invest in. If you have an investment fund in the Cayman Islands, it's not investing in the Cayman Islands. There's a limit to the number of pina colada bars that you can finance. It needs to go into the industrial countries in order to do some good and earn some capital. So in both those ways, by keeping a brake on taxes in high tax countries, and by allowing pooling of international capital and therefore more efficient funding of business, we're increasing wealth. Now, fine, people say, even if they accept that, that's great, but who's it increasing wealth for? It's increasing wealth, isn't it, for the wealthy who've got the money to invest in these offshore countries. It's increasing wealth for the businesses, the big corporates, the big global companies who are setting up subsidiaries in these low tax jurisdictions. Well, yes, that's the most obvious result of it. But actually, what it's mostly doing is creating jobs. It's making employment. It's by investing, it's making those jobs more efficient and therefore providing higher salaries and more stable jobs.